Hello, everyone, and welcome back to Your Finance TV. A little bit of a different backdrop today as I'm recovering from my ankle surgery. How are you, Jay? Welcome back for your musings.
Scott, great to see you, buddy, and good luck with the quick recovery. I understand you're on the recliner. How's that treating you?
I am on the recliner, and it's not a comfortable place to sleep in each night. I can assure you of that. It is
Mm.
good for a nap, though, but I really do need some sleep. But you know what? I've actually had the pleasure of already having a quick look into your musings for this week with the title of Lean into Complexity. Now, obviously, like when you have your other titles, I can usually pull something out of it. But I think for the viewers, why don't you tell us the reasoning behind this title this week?
Yeah, Scott, it's interesting, right? Because we've been thinking and talking about over the last couple of months the importance of having a framework and a process if you're going to do global macro investing, right? And that's been our game for 30 odd years, both on the sell side and the buy side. Now at TPW Advisory, providing clients with portfolio strategy and asset allocation advice, as well as our two model portfolios, our global multi-asset model and our TPW 20 thematic model. And really, given how fast things are moving and given all the uncertainties that we've seen over the last couple of years, it really has paid to have a framework and a process. And our framework continues to pay dividends. That tripolar world framework, that argument that regional integration and regional deepening in the three main regions of Europe, Asia, and the Americas is going to be the operating system for the global economy going forward. That's been our view. We first started writing and talking about that over 12 years ago now, and it continues to pay dividends. And just as an example, currently in our model portfolio, our global multi-asset model, we have an infrastructure allocation. We have a big emerging market equity allocation, significantly overweight EM equity, the biggest overweight we've had in a couple of years. That process of regional integration is driving both of those allocations. Infrastructure is going to be a big winner as each region tries to deepen its integration and deal with the three C's of COVID, climate, and conflict. Emerging markets are going to benefit from the regionalization of supply chains as we go from a global supply chain to a regional supply chain focus. That's going to increase resiliency. That's going to help with macro stability. And it's going to bring the emerging markets closer to their developed market neighbors. And so for the first time in years, we have EM equity allocations in each of our three regions. So we have Poland in Europe. Poland has been a rock star for us over the last couple of months in our model. We have Brazil and Mexico in the Americas. Mexico, Brazil, some of the best performing emerging markets this year. And of course, we have China in Asia, and China has been our problem child because it just doesn't seem to want to work. And we'll get into that a little bit later. But it's important for us to work through our process and our framework. And sometimes it yields insight. And in this week, where we did our model portfolio update, we felt like we got some insights that we wanted to share. And the main one is in the title, Lean into Complexity. And, it makes sense. If you're doing global macro, you are not fazed by complexity, right? It's the most complex investing model that one can have. You're looking at everything all around the world. So leaning into complexity for us is not really new, but it struck us that at this particular point in time, coming off in a face-ripping November rally, which virtually no one saw, right? An economy that refuses to go into recession. We think you need to lean into complexity to be successful in today's investing world.
Now, your musings, which everyone can sign up to at Pelosky.com, like you and I have been talking for a couple of years now, and there's many examples you've had over the couple of years. Like, can you, for viewers who are just joining now, or even just a recap for some other viewers, can you give us some of these examples?
Well, I think it's important for people to understand that one of the benefits of being an independent boutique operation like we are at TPW Advisory is that we're able to actually work in complexity at speed. And complexity and speed together leads to breakdowns in many organizations. And so I think we've seen some of this in the last few years in the macro space with the big firms, right? Because the big firms have to try and shoehorn different points of view together. They have diverse outlooks, their Asian strategists versus their global strategists, their Latin American economists versus their global economists. And they have to put all these things together and kind of homogenize a firm view. And it's been no surprise to us that from a macro perspective, one of the things that clearly has happened over the last couple of years is that people have been stuck on repeat in terms of calling for recession, right? We've had 2 years of many of the largest and best staffed and most resourced firms in the world all calling for recession, all being wrong. And I think one of the reasons why they've been wrong and consistently wrong is that they focus on looking backward and using historical models at a time when, if you're independent and if you're able to focus forward and embrace the complexity, you realize that we are in an ahistorical period, which is something we've talked about at TPW Advisory since COVID. It's ahistorical, and thus using historical models to predict the future in an ahistorical period is going to be garbage in and garbage out. And so switching to a market kind of example of what I mean by leading into complexity, let's just take the latest example of the November rally, right? As you know, and your viewers know, we've been very constructive, right? Fully invested, overweight equities. And we rode through the pain of August, September, October, 3 months, 8% or so correction in the S&P, because we felt that there was the opportunity setting up, and that opportunity manifested itself in virtually a heartbeat in November. And almost within a month, completely wiped out the declines of the prior 3 months. It's an example of why you don't market time, right? How many folks sold back in June and July and bought back at the end of October? Very, very few, I'm willing to bet. And so the smart money, hedge funds, completely wrong. Massive net shorts going into November. And the dumb money, retail, completely wrong. Retail sold the most equity they've sold in years in November. So this is an example on the market side of leaning into complexity, having a point of view that's rooted in the present and the future, not dependent on the past, and being able to articulate that and put it into a model framework that allows clients to benefit from that distinct and differentiated point of view.
Yeah, quick sidebar here. It's interesting time of football season, obviously, especially on the college side as we go into the bowl season. And Duke's going to obviously have a bowl game this year. But you're a big fan also of professional football as well, right?
Well, it's interesting, right? Because I am a fan of football. I think it's a fantastic kind of game of strategy and skill put together. And what I've noticed is complexity is increased there as well. And I'll give you 2 quick examples, because I'm sure some of your viewers may not be football fans or American football fans. But in essence, if you think about the pro game, NFL football, which, by the way, is the most popular thing on television, right? The biggest audiences for live TV viewing are NFL football games. It's been the case for years, continues to be the case. What's exciting today is how coaches are using all the personnel in every inch of the field to gain a competitive advantage. And so what used to be static, namely the positions of different players, has now evolved into something that's much more complex, particularly as coaches on the offense use motion, taking people and moving them around the field before the snap to confuse the defenses and to get an edge on offense. It's really, really exciting to see that concept then be employed across the entire football field in an effort to gain success and to gain an edge. And the NFL is a very meritocratic institution. And so those that embrace the complexity win. Those that don't, they get fired. And so it's a great example of what I mean by leaning into complexity and capturing the upside that complexity offers. In college, it's a little bit different because the complexity and speed is off the field, right? So here I'm talking about the ability of kids to transfer and play within the same year, plus the name, image, and likeness, new legislation allowing kids to be compensated for their name, image, and likeness, NIL, which I'm sure most people have heard of. The combination of those two things has meant that athletic departments across the college campuses across the country are having to move in a world that they're completely unfamiliar with, right? Much, much faster. Things changing in a real rapid way and becoming much more complex. And so what's the solution here? The solution here is to be much more collaborative, right? The coach, the player, the athletic department, and the collectives, which are these groups of fans or boosters who provide the NIL support, all have to work together if you're going to be successful. And you want to be successful because college football drives the entire college athletic financial system, right? Again, college football is the most successful, highest paid sport in college sports. And so for whether or not you like college football, let's say you like soccer, or let's say you like women's softball, or let's say you like fencing. Both my sons are fencers. Guess what? Fencing doesn't generate any revenue or profits for the university or college. Football does. And so when you think about football and you think about NIL and transfer portal, keep in mind that the schools that get it and integrate successfully and leverage that collaborative process are the ones who are going to win. And winning means being able to fund all the other non-revenue sports. And that is the complexity that's unfolding in real time in college football, which has been really, fascinating to observe.
Yeah, well, it'll be interesting next year when they expand the playoffs because Florida State's not really enjoying college football right now. But what does this all have to do with investing, though, Jay?
Fair question, right? Fair question. But I pull those two things together because part of the insight into lean into complexity came from watching the football stuff and just thinking about how the game has changed on the pro level and how college football, which I know quite well from my work at Duke, is changing just super fast. And so there is a tie-in. And what it means in investing, the game is changing in investing on the information side, right? If you think about it, there's more information, more opinion, evergreen recession as an example, coming at you from more different places all the time. And the point that we would make is that more information, more opinion, more readily available does not make it easier to outperform. In fact, it makes it harder because separating the signal from the noise has become more and more difficult over the last couple of years. And so rather than look forward, many have defaulted to looking backward, as I talked about with the big firms and their use of models, historical models. Well, guess what? In our view, looking back has never been less valuable, in large part because ChatGPT can do it for you. So if you're one of the folks who spend a lot of time looking backward to try and figure out what's going to happen going forward, you need to switch and get ChatGPT, have that look backward for you and focus forward, at least in our view. The utility of looking back has become significantly devalued, in our opinion. The ability to look forward and utility of looking forward has become increasingly more valuable. That's true on a career path, and that's true, I believe, in outperforming in the markets.
So you talk about that. You looked at data. You obviously everything is moving so quickly. Obviously, you look at this for your portfolio as well, and as you've probably done this week, gone through some things and changes. You mentioned China there before, which is obviously where you think it should have been to where it actually is. Like, is there any changes you've got coming through in your portfolio?
Well, one of the things that we do as part of our model portfolio update, which we do once a month at the end of our period. So our period is we write every Friday musings, and then we go on YourFinanceTV and have a great convo. Once a month, we do a deep dive on our monthly. That was last week. On Track was the title there. 5,800 words, 29 charts and tables from 16 different research sources. And then this week, having brought it all together, we update our model portfolios. And one of the things we do in that process is we look at the technical charts, the technical picture of all of our holdings, all of our benchmark indices, and any new ideas we're contemplating. And it's pretty clear what's happened, right? Obviously, charts have gotten much better because the market has gone up. So pretty much all the equity space, much of it is above the 200-day moving average, widely considered by technicians. And we're not technicians, but we are equal opportunity users of things that help us. And we think technical analysis is something that helps us, particularly in this ahistorical period, right? Where we don't really have a lot of things to hold on to help us understand what's going to happen down the road. So technical analysis at least tells us where we're at and gives us a sense of where we could go. And so we do look at the technicals. Equities look good. Bonds are struggling to get back above the 200-day. Commodities well under the 200-day, no surprise. Oil down 7 weeks in a row. And so what that means, very, very top line, is that their bonds are overbought. Commodities are oversold. There's not much to do in those two buckets, right? So we focus our attention on the equity bucket, and there things are working out well for us for the most part. We had a very strong November, in part because we're overweight equities, in part because we're overweight emerging markets. 3 of our top 5 performers over the latest period were emerging market equity holdings. So we didn't really do a whole lot. One thing we did do, talking about that infrastructure opportunity earlier, we did add to our infrastructure holding, becoming big believers that the next couple of years interest rates come down, global macro stability. Remember, that's our 3rd macro surprise for 24. Global macro stability, lower interest rates, continued government, public-private investment on semi-chips, on infrastructure in Europe, fit for 55, next gen, et cetera. Infrastructure is going to be a big winner from the regionalization process that we see unfolding right in front of us. So we added there. One of the other things we did was we looked to add in the tech space to a sector that we think is really increasingly interesting, and that's in the cloud space. We're increasingly of the view that semis and cloud are the 2 most immediate winners of the AI age. And so in our TBW20 model, we increased significantly our cloud allocation, and we instituted a new position in that space in our global multi-asset model. The other thing we did, as I touched on, was we addressed China, because we've been quite bullish, and that's been quite wrong. China were amongst the bottom 5 in our global multi-asset model over the latest period. And the fact that it didn't rally at all when pretty much everything else was rallying tells us something, and it tells us that we're wrong. flat out. So we reshaped that position. We're still there. We're still overweight. We're just less overweight. And we can carry that overweight because other things are doing well, right? Not everything in the portfolio is going to do well at the same time. If it does, that's a problem because at some point it's all going to go down at the same time. So you want to have that balance of things going up, things kind of settling, and some things that are hopefully going to get ready to start going up. And that's the last is where we think China is. But it didn't really make sense for us to be as aggressive as we had been, just flat out. And so we've reshaped that, recognized that that our call there has not yet worked. We think it will, but it's going to take more time. And in the interim, other things are working, and that's where we want to allocate some more resources. And so that's what we've done. In essence, we didn't change a significant amount in either model. We think the outlook is quite good for 2024, right? Lower inflation sooner than expected. That's surprise number one. Continued productivity growth, surprise number two. Global macro stability, surprise number three. That unlocks the $1 trillion reward we've been talking about, all that money in money market funds. And then the fourth and final surprise, the early cycle versus late cycle debate gets answered with the early cycle guys like us, very few of us, the winners, and the recessionistas, the late cycle recession, those folks are going to be proven wrong. And so with that outlook, naturally we're constructive. And hey, we had a huge rally in November. Any pullback here makes perfect sense. Wouldn't be afraid of it, wouldn't be worried about it. Would look to use it to add to positions that you feel constructive going into 2024.
Well, Jay, thank you so much for this summary, but I've got one last football question for you. Army or Navy this weekend?
Oh, great question. Yeah, my son, my younger son is very focused on the academies as a possible place for him going forward. I asked him that question. He said it was a tough call to declare a winner. He's going to actually sit out the making that call. For me, it's a good question. I would think maybe Army has a little bit of an edge, but it's going to be interesting, and I'm going to be there to watch. But the big news, frankly, Scott, in college football is that Duke has a new college football head coach, Manny Diaz, formerly the defensive coordinator at Penn State, just last night accepted the head coaching job at Duke. And we are super excited to have Manny as our new leader.
Well, congratulations to Manny and to Duke. And for me, go Army.
There you go.
All right, Jay, listen, you have a great week, and we'll be talking to you again next week.
All right, well, get some rest there, buddy. I hope you get out of the recliner and into the bed.
Thanks very much. And for everyone else out there, good luck investing.